Kitco Mining's on-site coverage of the Vancouver Resource Investment Conference is presented by Discovery Silver.
Precious metals prices go wild. Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2026 Vancouver Resource Investment Conference. Joining me today is Ronald-Peter Stöferle, Managing Partner of Incrementum, who also publishes the In Gold We Trust report. Ronnie, welcome back to Kitco.
Good to see you, Paul.
It's obviously fantastic time. There's lots of smiles about. Very, very happy days for people in the precious metal space in general. Gold is at $5,000 per ounce. Silver was at $100 per ounce. We're probably 15%, give or take, over that now. Which one of those price moves has surprised you most?
None. No.
Fair enough, we can end there. Here we go.
No, I would be a liar. And you know, I'm not one of those guys now taking a big victory lap. I think we forecasted a bull market in gold, obviously. We forecasted it in 2020. We said it's going to be a golden decade. We said in last year's In Gold We Trust report, the big long, we said that actually now is the time, second half of the bull market, when silver and commodities start outperforming gold. So that played out pretty well. But I didn't expect silver to go, nuts and reach like triple digits so quickly. So it just shows you that there's an enormous amount of momentum behind. It shows you that there's lots of buyers with deep pockets. Every minor correction is being bought. And therefore, I think, we're in a bull market. We're not in a bubble yet. And therefore, I think the next couple of months will definitely be, let's say, interesting for precious metals investors.
Now, in the big long report you referred to, you were actually looking at the potential for higher prices than we're at today. So how's your view evolving? You talked about the momentum that's got us here, and that's perhaps got us here quicker than you anticipated. Do you see that momentum continuing throughout 2026?
I think so. Although, the market it's not a one-way street. Yeah. So there's going to be a correction. And, in absolute terms, if we correct by 15 or 20%, it's going to be $1,000. Yeah. And people will talk about, the gold crash or whatever. But I think it's going to happen at some point. From my point of view, a couple of thoughts. I think we have to ask ourselves, is this just a normal cycle, or are we at the beginning or already in the middle of a revaluation of gold? So really like a monetary event. And, if you value gold versus commodities, especially oil, it's expensive. It's not cheap anymore. If you value it in monetary terms, and we're doing it with the shadow gold price, for example, if you compare it to the debt levels and the growth in debt, it's pretty inexpensive. It's even cheap. So from my point of view, it seems that all those things that we are writing about for 20 years now, de-dollarization, going back to some sort of gold backing of our currencies, it seems that it's playing out. And I think it's going to be extremely interesting what's going to happen in the United States, 4th of July. The 250-year birthday for the United States. And I think, listening to Judy Shelton quite a lot, I think that her ideas regarding gold-backed U.S. Treasury bonds, I think, 1 or 2 years ago, I would have said it's not going to happen. But now I think, it's pretty realistic, yeah. So that gold is now really officially coming back as a monetary good. And I always said, the foundation of this bull market is something that very few people talk about, the so-called love trade. So the majority of the physical gold demand nowadays coming from China, from India, from the Arabic world. That's more than 2/3 of physical demand now. Then 2022, of course, we had the sanction against Russia. And since then, central banks are buying roughly 1,000 tons of gold every year. And now, finally, and this only started in 2024, Western financial investors started buying gold. So having a look at the flows, but also having a look at, let's say, the antithesis of gold, which is, from my point of view, government debt, which is a 170 trillion asset class. I still think that with inflation being pretty sticky, and perhaps a second or third inflation wave being around the corner, I think that the future demand for financial investors from the Western world is actually going to be coming from fixed income. Yeah. So many institutional players that I know, they say, well, actually, perhaps we should allocate at least some of our investments into gold. And let's face it, in the 1970s, there's lots of stories, and we'll cover them in the next In Gold We Trust report, where fixed income investors had 30 to 40% physical gold in their holdings. So we're far away from that, obviously.
Obviously, a lot to unpack there, Ronnie. I'll be facetious for a moment. Given the sort of the turbulence and the sort of increasingly aggressiveness, the hostile nature of things in the general environment as well. First question: will the United States celebrate its 250th birthday?
Will they?
Yeah. Will it get there, or will it fall apart before then?
I think it's going to happen now.
Okay. A more serious question. Let's go to a more serious question. A lot of the keynote speakers here who are sort of perhaps older and been through more cycles of talking about the cyclicality of markets, cyclicality of, the gold cycle. Is there an argument that this time could be different, that there's been a shift? The situation in the 70s, there were solutions and there were ways out of that. Younger keynote speakers at this event are suggesting that, there aren't the exits available that there were in the past. And so what we're experiencing now, there has been a shift.
Am I one of the younger keynote speakers here?
You're certainly one of the younger keynote speakers. But I'm not sure if you've been saying that.
Because I'm doing it for 20 years now, and I'm still one of the younger ones, which says quite a lot about gray hair in this industry. But it's good to see some really young people here at the conference. I really enjoy seeing the new generation of investors here. No, I think that back in the 1970s or beginning of 1980, obviously Paul Volcker raised nominal interest rates up to 20%. I think that's pretty much impossible due to the debt levels, not only U.S. government debt levels, but also private debt, corporate debt. So I think that's not going to happen. I think that, the solution for the debt situation, let's face it, just in the first half year of last year, we had, based on the IIF, 32 trillion of new debt, new government debt. Probably second half of the year wasn't less. So, there's this cartoon with the dad standing in front of a big mountain with his two kids, and he says to his kids, "Someday all this will be yours." Yeah, and I mean, having kids myself, it's definitely the debt situation is clearly worrisome. There's no easy solution. I think we can rule out real reforms. We can rule out, a deflationary solution to the situation. I think it's going to be a combination of financial repression and structurally higher inflation rates, and this is actually what we're seeing already. So that's kind of my somewhat boring forecast, yeah. But I think that's really going to be the most important driver or the most important starting point for asset allocation. And the interesting thing is I speak really like all over the globe, and if you talk to investors from Turkey, for example, from India, for them it's just natural to hold some gold because they're used to having like rubbish currencies. Yeah, they're used to very high inflation numbers. So for them, when it comes to structuring a portfolio, inflation has always been like one of the first concerns and one of the first things to think about when they constructed a portfolio. Now, here in the Western world, we had the great moderation. We had like inflation rates constantly falling. We had the interest rates constantly falling. People couldn't care less about inflation. And this has changed in 2022, obviously. I showed one chart by Bank of America where they show like lost decades for the 60-40 portfolio. And this started actually in 2022, obviously. But there's still a couple of years to go in this trend. And I think, as I've said again, the 60-40 portfolio, the traditional asset allocation kind of framework, this is that. And this is why we came up 2024 with the new 60-40 portfolio where we added some precious metals, obviously, what we call performance gold, so mining stocks, commodities, and also Bitcoin. And in real time, this new 60-40 portfolio is actually outperforming the traditional 60-40 by 25 percentage points since 2024. So pretty significant. So again, I think, there's a post-it on my mirror, on my screen, on my screen in my office, and it's a quote by one of my early mentors, and he told me, "Scare your investors out of bonds." He was way too early. He didn't see negative yielding debt. I think there was 21 trillion in basically guaranteed losses that we had in the bond market, but now he's totally right from my point of view. And I think this is really, if you study debt cycles, then you realize that at some point, even die-hard, let's say, fixed income guys realize, well, actually, we should at least own some gold.
Okay, now we're in Vancouver. Nearby, we've got the Whistler Ski Resort. In your recent In Gold We Trust report update, you featured the gold ski pass ratio. And in that, you say skiing has never been as cheap as it is this winter. However, everybody I've spoken to is complaining about the cost of lift tickets. What's going on there? Please explain that.
Well, we did that with Austrian ski resorts, where we got the long-term data. We asked Whistler, actually, and they didn't get back to us. Probably for a reason. No, Paul, for me, it's crucial to explain that gold's primary role is to protect and to increase purchasing power. So our gold beer ratio that we do for a couple of years now, how much beer does 1 ounce of gold buy you at the Munich Oktoberfest? This was pretty popular because I think there's a very high correlation between gold bugs and beer drinkers. So we said, okay, some other long-term comparisons, and then we found the gold iPhone ratio, for example, gold oil ratio, obviously, and then also ski tickets, because as an Austrian, skiing is one of the very few sports that we're really good at. Everybody goes skiing, and people are complaining all the time that the lift tickets are too expensive. And my view has always been, okay, change perspective, and say, well, it's actually it's getting more expensive, but that means that you need more units of euros to buy 1 unit of lift tickets. So if you measure it in gold, actually, skiing has never been cheaper. And I think this perspective is something that a friend of mine who's from former Yugoslavia, they lived through the hyperinflation, and he only thinks in gold and silver terms. So he's basically, calculating all prices in gold and silver terms. So for him, obviously everything is ridiculously cheap. And I think that's really, although it's kind of fun comparison, it's a fun chart, but the message is an important one. Gold protects and increases your purchasing power.
Okay. In addition to the In Gold We Trust report that you're perhaps most famous for, Incrementum manages money and invest in mining stocks or growth gold, as you call it. Higher metals prices, obviously good news for investors in mining stocks and a mining fund. How are you looking at, how do these high prices, how do they affect your decision making from here? Presumably you've made some pretty good gains. Your outlook on gold suggests that you're probably still sort of quite invested. What are you looking at investing in? How are you positioning now and why?
Yeah, so we run a couple of funds, actually, and I'm managing a commodity fund and an active gold fund. And we said, well, actually, I think that mining is probably one of the most challenging, one of the most interesting, and one of the most demanding asset classes. Because it's very much top down. You have to understand the cycle here. You have to understand the monetary cycle. Where are we in this gold cycle? But it's also very much bottom up, because as we all know, there's so much that can go wrong in mining. And there's quite a variety of risks, being, infrastructure, political risk, geological risk. So that makes it, for me, very, very interesting, very, very challenging. But my take has always been that mining stocks aren't really a buy and hold asset class. You really have to manage this asset class very actively, and therefore our benchmark isn't a mining index, but rather gold itself. So the fund wants to create outperformance to gold itself, using mining stocks with a very broad spectrum. And last couple of quarters have been tremendous for us, obviously. But again, it's not a one-way street. Yeah. So we put in some hedges. We reduce some risk in companies that we don't like that much anymore on current price levels. I think that in this cycle going forward, at some point, the junior mining stocks will really start outperforming the large caps. So only last year, we saw that gold mining stocks started outperforming gold. But we still had this underperformance of the small caps versus the large caps. And usually, at the later stage of a bull market, you're seeing mining stocks outperforming gold. Check, got that. And then we should see the junior mining stocks massively outperforming the large caps. We haven't really seen that yet. It's getting started. And we're seeing that, risk appetite is here. All the messages that I get from brokers, there's a financing, and 10 minutes later, it's heavily oversubscribed and they're raising it. So there's risk appetite there. But I can tell you, outside of our little gold bubble, there's still very, very few people that are actually interested in mining stocks.
I went to see the Canucks ice hockey game yesterday, and sitting there in the arena with, 20,
Did they lose again?
1,000 people. They did, 3-2. Pittsburgh Penguins.
I saw them losing on Friday.
The Pittsburgh Penguins are staying in the hotel I was staying in. But it struck me that most of the people in that arena probably weren't even aware that gold is at $5,000 per ounce, and certainly not aware of what that potentially means. But getting back to the mining stocks, it sounds like you're perhaps rebalancing and recycling from the bigger names into some of the juniors to be able to experience that uplift that you see coming in the junior space or the developer space.
Absolutely. I mean, still, I'm really looking forward to the full year results. Yeah, and it's obviously the last quarter is crazy numbers probably coming out, and I think that more and more, let's say, value investors out there will actually realize that there's enormous amount of value on the balance sheets, an enormous amount of free cash flow production, more and more shareholder value being created. Most of the deals actually that are announced totally make sense. We haven't seen any crazy M&A activities yet. It will happen at the end of the cycle, obviously. But I think, for the large cap producers, I've rarely seen them in a healthier condition, and I would say, like, I had I think 180 management meetings with mining companies last year, and still most of the CEOs don't really believe in this move. I remember in Beaver Creek and in Colorado Springs, for example, there's very few companies actually thought that gold can, over the longer term, stay above, say, 3,000, 3,500. Now we're trading above 5,000. So I think, they will, at some point, they will really update their long-term forecasts. So I would say we still have to be selective. Yeah, there's lots of quality names at really reasonable prices. We like a lot of names in the junior space at the moment, but don't chase the market at the moment. As I've said, we didn't hit the brakes in our fund, but we took our foot off the gas pedal. Basically, we put in some hedges. We took profits in some of the names. I think there's gonna be some sort of a correction in the next couple of days.
So there'll be a better buying opportunity in the future.
I mean, we're not all out. Yeah, we're at a 62% allocation at the moment. Yeah. But I think, I'm seeing when it comes to the sentiment is extremely optimistic. Just this morning, I got I think 8 emails from newspapers all over the globe. Even those, I would say, kind of more tabloid style newspapers that are asking me for my gold forecast and what's happening to silver, which is usually not a good sign. Then there's another fun indicator, which is my ex-girlfriend. She hasn't called yet. She nailed the top twice in silver. So perhaps she lost my number. I don't know. But I hope my wife isn't watching that.
Okay, no, but let's change tracks. You're a fund manager. You mentioned 2025 results. They're due out in 2 or 3 weeks' time. I think a lot of people expecting bonanza, bumper results, big surprise to the upside. And so, as a fund manager, what are your thoughts on, what would you want the miners to be investing those bumper profits into? Where do you, in terms of the use of proceeds, where do you want those going? This morning, a couple of big transactions were announced. Kitco Mining is to pay $5.5 billion to take over Allied Gold, a big producer in Africa and growing producer in Africa. Orezone Gold is buying Casa Berardi from Hecla Mining. An interesting transaction that. Orezone's developed to build a gold mine in Africa. They're now obviously pivoting to diversify risk, presumably by getting an asset in in Quebec, in Canada. How do you want to see companies using these incredible funds that they're going to be generating?
One thing that I don't really want to see is higher dividends. I think that, if you just compare the daily volatility of mining stocks to the potential dividend yield, well, actually, it doesn't really make sense. If I'm getting like a 3 or 4% dividend yield with annual daily volatility significantly above that, from my point of view, I don't buy mining stocks for getting a dividend. Yeah, that's just my view. I think companies should actually stay somewhat conservative, invest. Mainly, the most of the value is created on the drill bit. I think there's gonna be more activity when it comes to brownfield. There's some. I think one of the deals that I really like was Jonathan Odd. With his Hemlo deal. I think it's very interesting what they're doing over there. It's one of our largest positions in the fund. They just put out really nice drill results. And I think those type of deals, basically large cap producers spinning out non-core assets, and then a little bit smaller companies actually, buying them and, just optimize it and drill. I think this is the kind of deals that I like. And I think we're going to see more of that. And again, I really hope that management teams will stay somewhat conservative, sensible, that they will not go crazy like in the last cycle. But to be honest, I think at the end of this cycle, we'll see crazy M&A. We'll see really useless deals. It's always the same. And there's quite a lot of pressure on, I think, management teams, growing more aggressively. And at some point, I think they will not be able to withstand that, resist that pressure.
Okay, the next In Gold We Trust report, that's due, April, May?
May 20th.
They typically have a theme. What's going to be the theme for the next one?
Well, it's going to be the 20th In Gold We Trust report. So I'm doing that for 20 years already. And I still enjoy it. And I still think it's the most fascinating thing, solving this 3D puzzle, geopolitics, de-dollarization, where's inflation, bond prices, whatever. So, analyzing and trying to understand gold is one of the most fascinating things. And as it's the 20th anniversary, the leitmotif will be the next 20 years. What's going to happen in the next 20 years? What's the price of gold going to be in 20 years, Paul?
I've absolutely no idea. I'm not even going.
Will we still be sitting here in 20 years?
We could be, but that's perhaps quite a sad thought if our lives take that trajectory. No disrespect to J. Martin and VRIC, but hopefully my life will enable me to do something else in 20 years' time.
No, but that's, look at really the big picture. This is what we're trying to do. That's, It's pretty demanding. Yeah, it's a pretty big challenge. But we've got a great team, and I really look forward to really getting into this tunnel and taking a deep dive and reading all the stuff that I get, and then kind of being the distillery of all those thoughts and ideas, and then writing the report. Yeah.
Well, I'm very much looking forward to that. I imagine it's going to be a very good issue because there's been so much going on and such aggressive moves in the pricing and other things related to the sector. Ronald-Peter Stöferle, many thanks for joining me today.
Thanks for having me, Paul. Always a pleasure.
And we have a lot more to come from the 2026 Vancouver Resource Investment Conference, so stay tuned and hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's on-site coverage of the Vancouver Resource Investment Conference is presented by Discovery Silver.